So he graduated from Indiana University, so not far from here. He talks about how he would drive up to Chicago for fun weekends. And now he currently lives moving to Phoenix, Arizona, so he's going to open an office out there and continue the business out there. But anyways, Daniel Cheung.
Good afternoon. I'm Daniel Cheung, CPA by trade. Our company is Aviation Tax Consultants. Matt can have it back there. They are from Textron Aviation. They sell airplanes. If your clients are in the market for airplanes, or if you guys are in the market for airplanes, those are people to talk to. But I can talk to you guys about the tax planning or the benefits available in terms of buying a business aircraft. I'm new to this conference, obviously. Are you guys all financial planners? Yes. No IRS agents? Anybody? No? That's good. There's always know who I'm speaking to. So, some of these topics, maybe you guys have some familiarity with, or some of the tax code and whatnot, but it's kind of high level. Wouldn't bore you guys with too many details. But a little bit about our company. We were started back in 2003, so this is all we've been doing since 2003. Our clients, again, are business owners, self-employed individuals, could be big companies too, but they all have a need for business travels, and our role is to come in as the plain tax guy, that's what I call myself, and work with their existing advisors, including you guys a lot of times, and the CPAs, attorneys, estate planning guys. So I'm kind of part of that team in terms of planning, but my focus is strictly aviation, whether it's income tax, sales tax, and there's a little bit of FAA compliance. So that's all part of what we do. Again, those are the three main topics: income tax planning, sales and use tax planning, and FAA compliance. The biggest kind of the draw to a lot of guys are, historically, a lot of our clients are pilots themselves. So business owner, whether it's, again, could be any number of industries or vocations, maybe a consultant, loves to fly and needs an excuse to ride on the airplane. That's when we come in and say, hey, can you justify riding off the airplane? But more and more we're getting non-pilots buying airplanes strictly for the transportation. And with the way airline travel is, TSA lines and security and all that, so more and more we're getting clients, they have no interest to fly. All they want is get in the plane, get in the back, relax, work, and then they have professional pilots getting them to places. But the people that we focus on, again, has to be a business reason to buy the airplane and ride on the airplane. If you're talking about a retired guy, there's really no business benefits to speak of. So those are not really the kind of people that we can help. Or even though a lot of times lately we run into a lot of business owners selling the business, so they have a big payday. And now if they are really truly retiring after they sell the business, again, we need a continuing business use for the airplane to justify the deductions, and not necessarily just year one, kind of a continuing need for the airplane for business travels. W-2 employees, the tax code is just not friendly to W-2 employees, unfortunately. Even though you could be CEO of a big company with plenty of income, if you buy an airplane for that business use, that business is still your employer's business. It's still not your business. So again, the guys we focus on, business owners, consultants, self-employed, 1099 contractors, type people. After the December 2017 is the latest tax reform, the reform in tax, the bonus depreciation come into play again. Bonus depreciation has been around for a while, originally back after 9/11, back in 2001, but it has evolved from 30% to 50% to 100% and back to 50. But as of right now, for the next 4 years until 2022, we literally have 100% bonus depreciation for even airplane. And there's no cap to how much the airplane is. It could be a $10 million, $20 million airplane. With the right fact situation and structure, the client or the business owner can write off 100% of the depreciation in year one. That's what's driving a lot of the industry right now. At least for the guys for the guys who can afford a $10 million plane, obviously they have a lot of income and a lot of businesses to justify it. So, but the bonus depreciation is the biggest draw. Even without bonus depreciation, the regular depreciable life on an airplane is 5 years. It's double declining balance, 5 tax years. So it's still very generous. I mean, an airplane lasts 15, 20, 30 years. But for tax depreciation purposes, even the regular depreciable life is 5 years. So if your client or your situation doesn't require 100% depreciation, you can certainly still spread it out and depreciate the airplane over time. Most of our client is what we call Part 91 personal business use. And if there's a commercial aircraft, like a charter, if you put the airplane on the charters with a charter company to charter the general public, that is what we call commercial, and the depreciable life is 7 years. Again, it's still very generous, even with the regular depreciation life, but the 100% is certainly available. And it's a small group. If you guys have questions, certainly stop me and raise your hand. We can address your questions. Go ahead.
Is that for new aircraft and used aircraft?
With the law change, it is now any airplane, new or used, or demonstrators, or anything in between. Used to be bonus depreciation applies only to airplane, but with the law change in 17, now it applies to new or used airplane.
You know, if the corporation buys the aircraft and it's not using it to its full potential, let's say you just did like a Cirrus or a Twin or something like that, are you allowed then to put it in a flying club, or does that muddy the waters?
It does muddy the water in the sense that, for example, if you have a client, a person, whatever, again, a consultant, flies his own airplane to conduct his own business, the deductions from the airplane is active trade or business loss, just like any other expenses you pay in the business. But if you convert the airplane into a leasing business, so you lease it to a flying club or lease it to a charter company for that matter, now you have a rental leasing airplane. Passive activity loss comes into play. So most people don't have passive losses. Real estate guys, they have passive losses from buildings and rents, but most of your typical client, running a business, they don't have a lot of passive losses. So by converting the airplane into a leasing type airplane, to a flight school, charter company, you're converting some of the losses deduction into passive. So if someone happens to have a lot of passive income, that's not an issue. But again, most people we deal with, they don't have a lot of passive income. So it does muddy the water, so to speak, because the deductions are limited to passive income. Yeah, this applies to all business airplanes, new, used, anything in between. And we run into the next slide here. I mean, the depreciation part is not really rocket science. I mean, you use an airplane is no different than any other business equipment. You can write it off. But with the airplane, the nature of an airplane, a lot of times hobby loss rules come into play. IRS loves to come in and say, oh, this is a toy, but this is really a legit business asset. So they love to, if there's an audit situation, those are the issues that are usually brought up, whether it's a hobby loss, passive loss I talked about. So a lot of times, and some of that is because of the FAA requirement and some sales and use tax planning requirement. We do utilize leasing pretty regularly to control sales tax and whatnot. So when leasing comes in, passive loss can be an issue. So a lot of planning is involved with addressing some of these issues. Related party leasing, for example, there is a tax code, little known to regular practitioners. If you lease the airplane to 2 or 3 companies that you own, you don't qualify for bonus depreciation. So a lot of times people will set up an LLC, buy the airplane, and lease to all these people. That's not a good idea if your goal is to take a 100% bonus depreciation. So all these are the topics that kind of the hot topics when we do planning. Personal use, obviously, it is very common. Everybody does have personal use. Your business use deduction, typically, it's just based on business use, personal use on an annual basis. So we have a tax flight log that we ask our clients to keep, for example. So every year we look at a flight log. Okay, it's 80% business, so you write off 80%. So there's nothing wrong with personal use as long as the owner understands there's a cost to the personal use, because if you have a vacation plan, that's not deductible. And there are different ways to manage the flight log, how you document things. Obviously, there are a lot of times, you go to Vegas for a week for a conference for 2 days and you try to bring the whole family. Those things are very common, a combination of personal and business. And depending on the facts and how you document things, there are different ways to mitigate the cost.
If the owner-operator is, let's say they're chasing another rating, commercial rating or something like that, would that be construed as personal use or business use?
Actually, that is specifically, by the tax code and regulation, that is personal use. I mean, you can be a pilot, you can get an instrument rating, that's okay because it doesn't change anything. But when you fly to become a commercial pilot, an ATP, that is a new profession. So by definition, that's not just a continuing education type use. That's, even though you may not be becoming a commercial pilot, that's not relevant. But the fact that the use of the plane is to qualify to become a professional pilot, that is technically personal use. So, and most of our clients, for example, especially the guys that are pilots themselves, I mean, they do have proficiency training every year. They have to do that to maintain safety and so forth. So those use is not a problem. But if you are flying the airplane to get a different rating to become a commercial pilot, that is technically personal use. Bonus depreciation is the most common incentive in terms of depreciation, but another provision called Section 179 expensing is also available. It does have a cap in terms of the cost of the airplane. It phases out completely about $3.5 million range. So if your client is looking at a lower range airplane, Section 179 is an alternative. And it's a generic 179 expensing if you deal with this code section with your clients. I mean, it applies to business equipment, desk, computer, anything, but it also applies to airplane. And the benefit of the flexibility of Section 179 is you can pick a number. Let's say you bought a $1 million airplane. You don't have to take $1 million 100%. Maybe this year you only need $350,000 in depreciation. You literally can target that number specifically to your situation. So Section 179 does allow some flexibility in terms of planning, and depending on the overall income, it does not always make sense to take 100% bonus depreciation. This is just a kind of very basic example of what's available. These are all taxed on aircraft, citation, King Airs, and different kinds of citations. I mean, 100% literally means 100% depreciation based on 100% business use. So your client spend $5 million on an airplane, assuming 45% tax bracket, you literally are saving, reducing the tax bill by over $2 million. And most people are much happier writing a check to Taxtron than to the IRS at the end of the year. So that's why, again, the business use and the depreciation available really drives the market lately. And you know, the economy's been going well. A lot of people are making money, and there's really so many cars and desks and cars, you know, you can buy to reduce your income, but buying an airplane certainly is a great way to.
From your using this slide, but on your previous talking about the hobby or just your personal use, I guess. So if you took this chart and let's say first year half the hours were spent taking a family on vacations, does that bring that number down to 50%, or how does
well, it does get a little more complicated than that. When the tax code was changed back in 2017, they give you this 100% bonus depreciation, which is great. But personal use, they put some limits on personal use. So back in the day, quite a few years ago, by utilizing what we call SIFL, SIFL, Standard Industry Fellow, it's an IRS published rate, by picking up some fringe benefit representing a personal use, now those personal uses considered a fringe benefit, you know, just like any other fringe benefits a company can offer to employees. So by picking up the little fringe benefit income, you treat everything as business. It used to be great, you know, everybody can literally have 100% business use, even with some vacations and so forth. But they did change the law, so we cannot do that. But what is available, again, this is a little known, it's kind of complicated. So we take 100% bonus depreciation, assuming 100% business use, but let's just say the reality is only 80% business use. And let's just use a $5 million airplane example. So 20% personal use, 20% of $5 million is $1 million. So on the surface, you have a $1 million reduction in your depreciation. But for whatever reason, IRS being kinder and gentler than Congress was, so now instead of $1 million disallowance representing 20%, that 20% is applied to the cost of the airplane on a straight line depreciation basis. What that means is, let's just say straight line depreciation over 5 years. Every year you have $1 million depreciation deduction. 20% disallowance on $1 million is only $200,000. So by making an election on the tax return, you are actually allowed to disallow only $200,000 instead of $1 million. So the answer is no, it's not directly a 20% reduction based on personal use or 30%. By making an election, you can actually reduce the cost of that personal use, and it applies for some reason to our airplanes only.
So then that gets picked up through through W-2 income?
It's not, actually the disallowance is disallowed like one item on the tax return. just like music entertainment is 50%. You pay a restaurant bill for $1,000, you can only write off 500. It's 50% deductible. So the personal use is equivalent of that. So whether it's 20% or 30%, that's a disallowance. But on specifically to relationship depreciation, it's only disallowed on a straight line method. It's very odd. I mean, it's very beneficial in terms of planning because again, everybody does have personal use, but the cost is not 20% of $5 million, which is a huge hit.
So it just kind of to go a little further, not a tax guy at all. So if you just the first year did 0 personal use, 100% write-off, January 1st hits.
You can't be a tax guy.
Okay.
Great idea. But no, literally, I mean, the salespeople don't like to hear this. I mean, literally, you buy an airplane on December 29th, one business flight, 100% business use, no questions asked. I mean, you know, there are questions asked and there's not, obviously. But you have one flight, 100% business, yeah, 100% business use. Now, 2020, the next year, you cannot drop to 0% by any means. You cannot drop below 50% actually. So as long as you maintain 50% or more, you don't have a recapture event. Bonus depreciation is what we call makers, double the time balance tax depreciation method. So anytime, as general rule, anytime you drop below 50%, you have to depreciate your asset on a straight line basis. So if year 2, they have 40% business use, you fail the 50% test, then you actually have to pay back everything from year 1 and then recompute everything on a straight line basis. Actually, I just had a call this morning. I was told some people buying a share of an airplane was told, oh, you can write 100% this year, but next year nobody cares. It really does matter. But 50% is the magic number going forward. So yeah, I mean, but in terms of planning, fourth quarter is traditionally the busiest time for us because everybody, they do some planning with you guys and say, hey, you have a huge year and a huge tax bill coming up on April 15th, what do you do? Again, you can only buy so many cars and tables. Yeah, you call the tax run to see what kind of airplane they have available, and a lot of times, literally, the OEMs, they run out of airplanes because you know, they can only make so many a year, and by the time December 1st come around, you cannot find an airplane to buy. That actually has been happening.
What's the time frame where the recapture doesn't create an issue, right? 50% at some point, I mean, at some point it's...
The depreciable life for the airplane is 5 years, it runs to 6, so at the minimum, the first 6 years, you have to maintain 50%. Now, there's always, I always call it a smell test. I mean, you know, let's say you write off a $5 million airplane, obviously you can afford it to buy it, but you still need some business justification on an ongoing basis. I mean, for example, I talked to Family Doc that makes a lot of money, but they have one office 3 miles from their house to see patients. So it doesn't matter how you spend it. You just can't justify an airplane to go to your office. Now they need to go to continuing education and whatnot, but those are not revenue generating type activities. So now if you have the same doc with a satellite office, remote office, you know, 250 miles away, up in the mountains, that, you know, take them 5 hours to drive to versus flying in 45 minutes. That becomes a good justification for a business airplane for the same guy. So again, some of this is kind of trying to think outside the box a little bit, even though you're not everybody can just say up in the second office to justify the airplane, but a lot of business these days, you know, the business owner, you have some flexibility. Okay, yeah, I want to grow my business, I want to go to the West Coast and whatnot. So, but the smell test is what I call it. The airplane does have to be what is called ordinary and necessary in IRS terminology. So, is it ordinary to have a medical doctor with one office to have an airplane? Probably not. But if you have 2 or 3 offices, that's good. But those are the income tax topics. Again, that's really driving the discussion or the interest of somebody that can use that kind of deductions. Sales and use tax planning is another big area, again, especially you're talking about multi-million-dollar airplanes. Every state is different, so this is a very general discussion. Sales tax, for example, tax run is based in Wichita, Kansas, so most of the customers pick up the airplane in Kansas. And most people don't live in Kansas, so you don't really have a sales tax exposure in Kansas. What Kansas has is what we call a flyaway exemption, for example. But when you bring the plane back to your home base, wherever it is, Pennsylvania, Indiana, whatever, that state can tax the airplane. It's not necessarily sales tax anymore, it's use tax, but we typically use the term sales and use tax rate interchangeably. Most of the time it's the same rate. So if you have clients with airplane, a lot of times you will hear people using Delaware LLC. And because they hear the buddies say, hey, Delaware has no sales tax, just Delaware LLC buy the airplane and you have no issues. But the reality is you absolutely have issues because when you bring the plane back to Illinois and base the airplane here in the Illinois airport, Illinois Department of Revenue is very interested to slap you with that 7 or 8% sales tax. So sales tax planning, especially in the higher end market, is certainly a big topic of discussion. I mean, most of the states, the lowest state probably is 5% sales tax, but it can be up to 8 or 9 or 10% like in California. So depending on the state that the airplane is fiscally based, that's the state that we need to think about in terms of sales and use tax planning. And with clients with multiple homes and multiple offices, if the plane spends a lot of time in 2 different states, for example, second home in Florida, then we even have to worry about Florida's attempting to tax the airplane. So sales and use tax is based on where the airplane is hangared, where the airplane lives. So it's not so much what resident the owner is. It is based on where the airplane is physically hangared. For example, right here in Illinois, actually I think I have a slide right here in Illinois. For whatever reason, they love to tax, they need tax revenues here. They are very broke. So Illinois pretty much does no exemption for sales and use tax unless you put the airplane on a charter certificate as a commercial airplane. So if you find an airplane based in Illinois, you pretty much have to write a 7 or 8% tax check. But if you live in the northern suburb or you live downtown Chicago, Gary, Indiana is a short train ride away. With traffic and all that, is actually pretty easy to get to Gary. So a lot of our planning literally will tell the client, we're not basing a plane in Illinois, we're basing it in Gary, Indiana. And now Indiana law applies. And Indiana does have different types of exemption available to the sales tax. So Indiana has a 7% sales tax, for example. But because of some of the exemptions available, you don't have to write a check for $700,000, for example, on the $10 million airplane. So sales and use tax, again, the planning is based on where the airplane is based, and the airplane is a very mobile asset, so sometimes there's nothing wrong with basing the airplane across the state line at another airport that has more favorable tax laws. Back one slide, these are the typical exemptions we work with. Again, there are 50 states out there, 7 or 8 or 9 states maybe do not actually have any sales tax on airplane. So you have a New York-based client, New York actually get rid of the airplane sales tax, period. It's kind of hard to believe, but they literally eliminated sales and use tax on airplanes. So what happened was, used to be all the airplanes is based across the state line in Connecticut and other states. Now all the airplanes coming back to New York. So again, there's a lot of flexibility in planning where you base the airplanes. Sales and use tax certainly is one of the considerations. Interstate commerce exemption is another common. Well, actually, it's not common. A few states have it. California, actually, as bad as California taxation is, California has the best sales tax exemption in interstate commerce. 6 month, 50% business use, you pay 0. That's it. So for any California client buying an airplane, nobody should ever write a check for sales tax. Commercial use is 135 and chartered. Some states have what is called a casual sale exemption. So those are the typical exemptions that we work with in terms of sales and use tax planning. FAA regulations compliance, again, that's the kind of the third leg of what we typically address with our clients. Most of the business owners using the only airplane is what we call Part 91 operation. Part 91 regulations applies. And you pretty much can do anything you want when you own your own airplane. You fly whenever, whatever weather, how long the runway is, there's no limitations pretty much. There are a couple of things that we'll address that prevent you from violating Part 91 rules. For example, the next regulation is called 135 when you charter an airplane. And there are a lot of different limitations and different tax ramifications for that matter. So when we set up ownership structure and planning, those are the kind of issues we address depending on what the motivation of the client is. Some client may buy a beat up jet and just charter the heck out of it and make money as an investment. That can happen. But they have to understand, again, some of the passive loss rules and so forth and FAA compliance. So those are the issues that we work with our client. I think I'm actually running out of time. So again, my role, I'm not the regular tax guy. So you have clients that has the regular tax people. If they are looking to find an airplane, a lot of times they'll bring us in as the tax specialist addressing all these tax specific issues relating to aviation.
You said the tax write-off is till 2022, so we have to buy it December 31st of 2021 or December
22.
22?
Starting 2023, actually it goes down to 80% bonus depreciation. It's not the end of the world. But the law as of right now is 100% until the end of 2022. This is a slide, that cartoon. It's actually very representative of why we got brought in a lot of times. A lot of times you talk to a regular tax person, they'll probably tell you, don't buy the airplanes. The big audit risk is not worth it. But the reality is really it's the opposite. I mean, I like to say this is the biggest myth, because every one of my clients has airplane, and we certainly do not have anywhere close to 100% audit rate. In fact, our audit rate is low single digit, very, very low. Again, with the right structure, that's kind of what we do is we try to mitigate the audit risk by putting the airplane at the spot and an entity that doesn't draw attention to the taxpayer. Because certain situation structures certainly will draw attention. If you write off $10 million loss on a K1, yeah, IRS would love to see what is this about. Yeah, oh, it's an airplane. Yeah, go to ask questions. So the law of planning involved with aviation and with the right structure is certainly very doable, but ultimately, at the end of the day, you have to have a business justification first and foremost. I mean, it's not spoken merit by any means. So if you have clients in that situation and that will consider a business use airplane, certainly there are a lot of tax benefits available.
So you're brought in every year as the return is being filed, or just upon the initial?
Yeah, we typically get involved on an annual or maybe even a 3-year basis. So it's kind of a retainer, whatever. I mean, my clients will call us, we'll review the flight log at the end of the year, and the CPA will call us a few times a year, especially come tax time. So we'll review the return. Again, we don't prepare the actual tax return. We work with the existing CPA that handle the tax preparation. And we do work all over the country. And most of our time we don't ever meet our client in person because they're calling me from whatever part of the state or the country. So most of the work is done by fax and not fax, email, and conference calls and so forth. So that's what we do. And I do have some brochures and business card if you guys want to talk to me. I'll be here today, tomorrow too. All right. Thanks for coming. Appreciate it.